Hello, and welcome to our journey for personal wealth. Inflation can be a complex topic for many people, but today we'll break it down in a clear and simple manner, providing real-life examples to help you grasp its implications. Let's dive right in and unravel the concept of inflation. What is inflation? Inflation is the rate at which the general level of prices for goods and services in an economy is increasing over time. When inflation occurs, the purchasing power of money decreases, meaning that each unit of currency buys fewer goods and services than before. Essentially, inflation erodes the value of money, making it harder for people to maintain their standard of living or plan for the future. Causes of inflation. Inflation can be caused by various factors, but the two main causes are demand pull inflation. This occurs when the demand for goods and services exceeds supply, causing prices to rise. For example, during an economic boom, people have more disposable income, leading to increased spending and higher demand for goods, which in turn pushes prices up. Cost push inflation. This happens when the costs of production for goods and services increase, forcing businesses to raise prices to maintain profit margins. For example, if the price of oil rises, it can increase transportation and manufacturing costs, leading to higher prices for goods and services that depend on these inputs. Let's talk about real-life examples of inflation. The price of a movie ticket. Imagine that 10 years ago, a movie ticket cost $8. Due to inflation, the same movie ticket now costs $12. The increase in the price of the movie ticket is a result of inflation, which has eroded the purchasing power of your money over time. The cost of groceries. Let's say that last year, you could buy a loaf of bread for $2. This year, the same loaf of bread costs $2.50. The increase in the price of the bread is an example of inflation, as the overall price level of goods in the economy has increased. Your salary. Suppose you earned $50,000 a year ago, and due to inflation, the cost of living has increased by 3%. To maintain your purchasing power, your salary would need to be adjusted to $51,500. If your employer only gives you a 1% raise, increasing your salary to $50,500, you will have effectively experienced a decrease in your real income due to inflation. How does inflation affect you? Inflation impacts various aspects of your financial life, including savings. Inflation erodes the value of your savings over time. If you have money saved in a low-interest bank account, the rate of inflation may outpace the interest you earn, causing your money to lose value in real terms. Investments. Inflation can affect the returns on your investments. To protect your wealth and maintain your purchasing power, it's essential to invest in assets that have the potential to outpace inflation, such as stocks or real estate. Retirement planning. Inflation can impact the amount you need to save for retirement. To maintain your desired standard of living, you must consider the effects of inflation when planning for your future expenses and income needs. You might ask yourself, how can I be prepared for inflation? Here are some suggestions. Diversifying your investments across various asset classes, such as stocks, bonds, and real estate, can help protect your wealth during inflationary periods. Some assets, like stocks and real estate, tend to perform better in times of inflation, as their values can increase along with the general price level. Including a mix of assets in your portfolio reduces the risk of your investments losing value due to inflation. Investing in assets that generate strong cash flow, such as dividend-paying stocks or rental properties, can help you maintain your purchasing power during inflation. These assets provide regular income streams, which can be used to cover expenses or reinvested to grow your wealth. By focusing on cash flow generating assets, you can better weather the effects of inflation on your finances. An emergency fund acts as a financial safety net during unexpected events, such as job loss or medical emergencies. In times of high inflation, having an emergency fund becomes even more crucial, as the cost of living can increase rapidly. Aim to save at least 3 to 6 months' worth of living expenses in a high-yield savings account or a money market fund to ensure you have a cushion to fall back on during inflationary periods. Preparing for inflation is a critical aspect of financial planning. By following these tips and strategies, you can protect your wealth, maintain your purchasing power, and ensure your financial success, regardless of the economic environment. Stay informed, stay proactive, and stay prepared for inflation. We hope that the information we shared in the video will help you along your journey. Don't forget to like the video and take a look at our channel for more educational content. Until next time, keep learning.